Welcome everyone to this real life trading video on collars. My name is Brad Reed and I am a real life trader, and I would like to encourage you to be good, and by good I mean get out of debt, achieve your financial dreams, and give generously to your community. Today is February 28th, and one of our traders, Maloney, has a position on Twitter, and it's been moving against her. And so Maloney says, "Hey Brad, what can we do?" Um, Thinking about covered calls, thinking about protective puts, and I was like, "Do you know about a collar?" And Maloney's like, "No," and I'm like, "Sweet." So collars are one of my favorite strategies. If you're in a long-term position, if you're buy it and hold type of trader, if you're the type of trader that likes to buy shares of something and hold it for a long time and just watch it run, a collar is a great way to get an extra couple of percentage points here and there. And I know traders that do upwards of 1 or 2% a month just with collars. So imagine that, another 12 to 24% on your annual return just by this one simple strategy. So what is a collar? It is selling a covered call and buying a protective put at the same time. And the idea is that you want to sell your covered call. You're going to want to put some time on it, and then a rather short-term protective put. And so what we were looking at here on Twitter, now Maloney's position, she got in at about 33.22. We can look at the covered call premiums, but I think 33 is going to be the better one. Now, one challenge here is that we're not quite at the right spot for selling a covered call. The best time to sell a covered call is when a stock has just started to roll over, when it's just started to show some bearish candles. So maybe 2 days ago was the better day, and the reason is that when it first starts to show the roll over, the premium on the covered calls is still pretty solid. When the stock is way down here, the premium on the covered calls is pretty low, but we got two other stocks we can look at to examine the premium that we can get. So let's say Maloney is okay getting paid to exit at 33. And again, when you sell a covered call, basically what you're doing is you're giving someone else the right to buy the stock from you at a set price on or before a certain date. So maybe we go out to April, somewhere around here, the third Friday in April. And that would give this stock all the way until then to get above 33, and then that person could buy it at 33, and Maloney could sell it at 33, but she's going to get money today to sell that covered call. And to sell her stock at $33, but she's going to get paid today. And then with some of that money that you get from the covered call, you're going to buy a protective put. Now, if Twitter wants to come up and come back down, then that protective put is going to go up in value a tremendous amount. But if it starts going up, you don't need that protective put to go all the way out to here, because we're going to know in the next week or two if Twitter's going to roll down or if it's going to roll back up. So we don't need as much time on that protective put. Today's February 28th. Let's look at the March monthly for the protective put and see what we can buy it for at 29. Again, when the stock price is way down here, these protective puts are going to be a lot more expensive, and the covered calls are going to bring in much less premium. But if we had done it, say, up here, or maybe on that day, or on that day, then protective puts are cheap and covered calls bring in a nice premium. Let's go over here to finance.yahoo.com, which doesn't always have the best options prices, but usually during the day they're pretty good. Options for Twitter, and I said I wanted the March monthly, so that's going to be March 15th for the put. And puts down here, I wanted the 29 strike. So I can buy the 29 strike put for 47 cents. Let's see, do I have a ray here for protective put at 29? Template, protective put, there it is. Okay, so I can buy March 29 strike for 0.47 cents per contract. Let's go see what the April covered call at 33 would bring. So to do that, I have to change my date to April 18, and the 33 covered call I can sell for 74 cents. April 33 strike for 0.74. So Maloney, if you do this today, you are going to get, what is that, 27 cents? Yeah, you'll get, so 74 cents you're gonna bring in premium, and you're gonna pay 47 cents. So you're gonna get 27 cents per share today if you do it. So Maloney, type in a 3 if you understand how you would bring in 27 cents per share today by selling a call at 74 cents and buying a put at 47 cents. She says, okay, got it. Now, there's 3 things that can happen, right? This thing just goes sideways. Boop. You keep your 27 cents and you do it all over again when it's all over with. So that's number 1. Actually, let's do it this way. Number 1. Number 2, it goes that way. If number 2 happens, your protective put is going to expire worthless. You're going to be forced to sell your shares at 33, but you still get to keep your 27 cents. So overall, you're up a little bit on your overall position since you got filled there at 33.22. Number 3 is this thing goes down, and then you've got choices. Now, if this goes down, your covered call here is going to go to 0, and you buy that back for 0 or a penny, right? So that basically is going to expire worthless. Your protective put is going to go up in value a tremendous amount. So what some traders do is they'll come over here, they'll put a protective stop right there. They'll exit the shares for a loss, but they'll hold on to this put because that put is going to go up tremendously when you get below 29. And then the third thing that can happen is this thing goes sideways until your put expires, and then it can start to take a dip. But by that time, your covered call has decreased in value, and you might, excuse me, you might be able to buy it back and then sell another covered call and buy another protective, but just kind of do it over again. But those are your options. Now, what would be a whole lot more fun is if we can get premium on a covered call, maybe at 34, and then you could sell your shares for a profit and bring in a profit right now. So the 34 strike is 56 cents. So I think that's what I would do if I were in your position. Is make that 34. 34 strike for, what did I say, 55 cents, 56 cents. Twitter, April 18, 34, 55 cents is the premium that you would bring in. So you'd still be getting a profit for today. You'd be protected on the downside. You'd be limited on the upside, but you'd bring something in. And then if by April, maybe it comes up and rolls or does something like that. And if it, if the stock is below the 34 strike by the third week in April, April 18th, this whole thing will just go away. You keep your shares, you keep your premium, your 11-cent premium, no, sorry, your 13-cent, gosh, I cannot do math, your 8-cent premium, which might pay for your commissions. So you'd be pretty much neutral, but you would be protected. Says it's got earnings on April 24th. Well, would you be comfortable selling a call over earnings? And you might get filled. So the May 17th is probably going to have a lot more premium in it. Ooh. The 33 you could sell for $1.71. So you would definitely be bringing in a healthy profit. 1.71. Excuse me, that's no longer April, it's now May. And Maloney, this is the exact game that we play with covered calls. Is what kind of strike do I use? How much time do I give it? And you must be okay getting filled on your covered call, right? I know people that they sell covered calls, but then when it comes time to get filled, they don't want to exit their shares and they start trying to do crazy, silly things that sometimes lead them into more risk of loss. But either one of these situations looks like you make a profit on your trade. You just have to be okay with getting filled. So again, if you don't know what a covered call is, it means you're giving someone else the right to buy your stock at a certain price before the expiration date. It may or may not get executed, but you get the premium and you keep the premium no matter what. So Maloney, type in a 2 if you understand, kind of the pros and cons. The more time you give it, the more premium you get, but then of course the more likely you are to get filled. But again, you keep the premium for selling the call no matter what, and you use some of that premium to buy protective put. Maloney says, I got it. I like 33 strike for May, so $1.71. So you're going to get a chunk of change right now. And the cool thing is, Maloney, excuse me, got a cough. The really cool thing is that if situation 4 happens, you've got enough premium in here, right? What is that, $1.24? You're going to get $1.24 that if this put expires and you decide you want to buy another one, you can buy another put. And yeah, you can buy another put and still have a profit on the overall trade. Some traders might say, hey, you know what, if I'm getting $1.71 here, I'm going to get more time on my put. I would say wait on that because if this does go up and wiggle up here, you can buy the 29 protective put maybe going from March through April for a whole lot less if the stock is up there. Ron's demerits here. What's up, Ron? Cool. So that was Twitter. Let's take a look at BABA. So BABA's been on a crazy, pretty wild uptrend. And maybe you are in this position and let's say you bought, oh, you're welcome, Maloney. That's what we're here for. Maloney, I'm going to throw some frequent trader points your way for getting this video, for kicking me to get this video recorded. Let's say you got in a position over here, somewhere on 168, 170 on BABA, and it's gone nicely in your direction, but wow, is it extended in the bullish direction? I wonder if we're getting signs of divergence. Yep, we do have some divergence showing here on BABA. But you know, maybe that divergence played out right there. Maybe it hasn't. At any rate, back to my lines. Let's say you wanted to do a collar. It's extended. The cool thing is on this one is that we're getting some resting action. I can sell a covered, I think I could sell a covered call maybe even as high as 200, and buy a protective put, let's say 173, 172.50, and that would lock in a profit for anyone that bought below that line. Let's go see what we can get. Again, it's February 28th. I don't think if this thing goes running bearish, it's going to do it very aggressively. So maybe I want to look out to the end of March, early April for my put. And yeah, why not? Let's go over earnings for the call. So I'm now looking at BABA, and let's see. Sometimes the dates get a little funky here, so I got to do this to reset the dates. So May 17th for the calls, and I said 200, correct? Yeah. So the 200 covered call I could sell for $3.80. Ray 200. All right, so let me find my little covered call deal here. There it is. Covered call, May, 200 strike, and I bring in, what was it? Did I say 380? 200, $3.80 if I do it right now. Now for my protective put, I said in the 172, 172.50 range, but I wanted a little bit more time than March. So let's see if I can go out to April. And I'm going to go down here to puts. I'm going to go, uh-oh, come on. Is it still loading? I'm not getting option prices. Am I limited on the strikes, or is it just thinking? List in the money. Maybe I'll play with the dates again. If I go April 5th. All right, now I'm getting the option strike. So 172.50, I could buy that for 298. So I could buy a put at 172.50. Protective put. And that would be until, you know what, I really want that March date. Let's see if Yahoo Finance will, sorry, the April date, cooperate. Give me the puts. Man, all right, I can't do it. So the information's there. You know what, I am just going to look in Interactive Brokers on another computer quickly because I really want to get that accurate number. Options trading. I am talking about the April 18th. So more strikes, April 18. And this was the put at, okay, so the 170 strike put is 292, and the 175 is 425. So April 18, that's a lot of time. You know what? I think I do like the April 8th expiration. Or excuse me, the April 5th expiration. Okay, April 5th expiration, 172.50 at 298. April 5th expiration, 172.50 strike for $2.98. So I'm going to put almost $1 in my pocket per share, and I've got lots of time for this thing to go up, and hopefully the covered call expires worthless and I can just sell another one. And again, with that much premium that I'm putting in my pocket, 82 cents straight away, if this put expires here and I decide I need another one, I only have to buy it for just a few weeks. And so I can likely still come away with a profit on this. So again, callers are selling covered calls and protective puts at the same time. The idea is to sell a covered call where if you get filled, you are happy to sell your stock for a profit and get paid to sell it for a profit, right? Because you're keeping the covered call premium. But you sell a covered call, and with the premium you get for the covered call, you buy a protective put and you get paid for that protection. But once again, folks, when you sell a covered call, you got to be happy exiting your position up there. It's got to be part of your plan. Folks, thanks for watching this video. For more videos like this, come on over to reallifetrading.com and check out all of our free education. You've heard me talking with people in the chat pane. We are doing a live webinar right now. It's supposed to be about day trading, but day trading kind of slowed down, and some people were asking questions about swing trading. So come over here, check it out, trade with us live. You guys rock. Feel free to reach out to us. And as always, trade on logic, not on hope. Have a good one, everybody.